Hi, everyone. This is the November and December public forum demo debate for Debate Us on the November-December public forum topic. Debating first in the affirmative, speaking first is Shiv Puliati, and speaking second is Tejas Balaji. And speaking second on the negative side, speaking first will be Alyssa McCartan, and speaking second will be Conrad Pallor. The affirmative can take it away.
We affirm in contention one is climate change. Unregulated mining for cryptocurrencies like Bitcoin is already deadly for the environment, as TAF21 writes that the price of cryptocurrency, as the price of cryptocurrency shoots up, so does the energy consumption as people are more incentivized to mine for more crypto. For instance, TAF continues that Bitcoin mining could easily use nearly as much energy as all of the world's data centers combined, which is why skyrocketing Bitcoin prices without regulation will lock the world into years of increased mining, emissions, use of fossil fuels in areas with high security risk and resource scarcity. That is why Mora 18 finds that projected Bitcoin usage alone could reduce enough CO2 emissions to push warming above 2 degrees Celsius within less than 3 decades. Preventing these emissions is key, as well as 19 concludes that as we could potentially avoid 150 million excess premature deaths from air pollution if we are able to hold warming at 2 degrees. Fortunately, as further cryptocurrency regulation is put on transactions and assets, regulatory agencies will have more tools to prevent any changes or damages to the environment. Indeed, Arbiter 21 finds that the EPA is looking to regulate various power plants that use fossil fuels to power cryptocurrency mining. Contention 2 is tax evasion. Currently, tax evasion is high, as Rapport 21 indicates that there are upwards of $163 billion a year in unpaid American taxes. This is fueled primarily by cryptocurrency tax evasion, because Barry 18 reports that out of the 7% of Americans that own cryptocurrency, only 0.04% report cryptocurrency gains and or losses. Catastrophically, this lack of reporting is the root of the problem in tax evasion, as Greg 21 finds that about 80% of unpaid taxes are due to underreported taxes, mostly from those who hide their income in opaque structures like cryptocurrencies. Fortunately, cryptocurrency regulation could crack down on such evasions, as Sigalos 21 writes that with the government giving the IRS an additional $80 billion to crack down on crypto tax evaders, the IRS has begun to implement data analytic tools, ramping up efforts to subpoena cryptocurrency exchanges for information about non-compliant US taxpayers, and labeling crypto as a property asset to decrease the ability to tax evade through cryptocurrency. This has been effective, as she furthers that the IRS has already sent tens of thousands of warnings for those who fail to report crypto income. Critically, Sigalos 21 quantifies that every $1 that the IRS spends on enforcement, cryptocurrency regulation would generate upwards of $5 in tax revenue. The US is the pinnacle of tax evasion globally, as Wallen 21 writes that the United States is the single largest, biggest loser of tax revenue globally. This tax evasion is devastating, as Oxford 21 finds that because tax evasion diverts spending towards public services in countries, money lost in tax evasion could prevent the death of 8 million people per year. Contention 3 is financial collapse. Cryptocurrency will continue to undermine the economy if left unchecked for 2 reasons. Subpoint A is cyber attacks. Cryptocurrency is currently the most preferred form of exchange in cases of ransomware attacks. Due to the decentralization of cryptocurrency, the FMS 21 finds that cyber criminals can hide their true identities when asking for ransom in digital currencies. When making an exchange, they can easily convert cryptocurrencies into traditional forms without ever being discovered, and as a result, there is no evidence that leads them back to their perpetrators, preventing any punishment. The impact is massive, as Thomas 20 finds that cybercrime has already decreased the US GDP by 4%, and Brandon 13 finds that each 4% increase in the US GDP lifts 3 million Americans out of poverty. Subpoint B is decentralization. Sir Waukee 18 finds that cryptocurrency is currently replacing our existing system in which the money supply is controlled by governments, which causes Bitcoin to be really appealing. But our economies rely on the central bank control of currency to deal with financial crises. An economy in which cryptocurrencies are dominant would be more volatile, with limited tools to fight recessions. And indeed, a set of just federal responses is key, as Dylan 18 finds that the Great Recession already put 64 million people into poverty, and Stone 15 finds that the 2008 recession would have been more than 3 times deeper and last twice as long. Fortunately, regulation will allow the growth of cryptocurrency without the negative implications. Thus, we affirm.
Okay, is everyone ready for the ninth case? All right, great. My time will start now. We negate resolved increased U.S. federal regulation of cryptocurrency transactions and/or assets will produce more benefits than harms. Contention one is migrant remittances. Immigrants working in developed countries often send money back to their families at home, creating an intercontinental cash flow. This is known as a remittance. Increasingly, cryptocurrency has been an invaluable tool in the spread of migrant remittances due to its zero transfer fee and the ability to be transferred overseas instantaneously. On Juno writes that cryptocurrency has long been hailed as the solution for the underbanked population of the world. With the currency exchange rates being incredibly high in most parts of the world, cryptocurrencies have emerged as a digital solution. According to the World Bank, up to 40% of GDP of some nations is dependent on remittance inflows. Cryptocurrency transactions are much faster than the official currency transfer channels, and their minimal transaction costs beat systems like the Western Union and MoneyGram. Unfortunately, cryptocurrency regulation threatens remittances. Jahani 21 finds that as regulators in remittance source countries like the US turn their sights to crypto, they should remember how indispensable those currencies are to some of the world's most vulnerable people. If we regulate cryptocurrency transfers to appease the crypto hawks at home, we might risk turning our backs again on those who need this asset class the most. The impact is a global poverty reduction. Adams 08 finds that households receiving international remittances spend 25.8% more on education than do households not receiving remittances. Remittance expenditures help raise the level of human capital in a country as a whole. Contention two is the economy. Increased regulation of cryptocurrency transactions threatens the US economy, and this happens in a few ways. First is offshoring. Increased cryptocurrency regulation will hinder the US dominance in the crypto space and push businesses overseas. Regulation would drive cryptocurrency developers and investors offshore because of the tremendous compliance costs and the harms to individual privacy and data security. Overregulation and punitive taxation could curtail this valuable pipeline to continuing American progress. Such a development would significantly hamper America's lead in fintech and other industries that will benefit from these technological breakthroughs. Second is scaring investors. Global Data 21 writes that one of the biggest criticisms of cryptocurrency has been the regulatory risks posed by governments. Regulatory volatility may scare off investors. People may fear that if they buy crypto now, there will always be a lingering chance that there could be a government crackdown that would render their investments worthless. Third is halting legitimate business activities. Dash Bahel 14 writes that government regulation restricts legitimate business and drives criminals underground, depriving the private sector at large of the benefits of cryptocurrency, such as speed, low cost, flexibility, and anonymity. Regulation would simply be driving the creation of another illicit market while denying the substantial benefits of cryptocurrency to law-abiding citizens everywhere. Any regulatory hurdles will inevitably hamper innovation. The impact is preventing a blockchain revolution. Blockchain is the decentralized technology that allows cryptocurrency to function. Although currency is one application of blockchain technology is key to the future for several industries. Cryptocurrency regulation harms blockchain-based projects. Berlau writes that experts see cryptocurrency financing as important to blockchain-based projects, from landing titling to medicine. Businesses relying on smart contracts and other blockchain-based technologies might ultimately move to alternative jurisdictions with friendlier rules. This development would significantly hamper America's lead in fintech and other industries. Widespread blockchain adoption in just one sector, finance, is key to responding to financial recessions in the future. Ferber writes that the 2008 global financial crisis would have been considerably less chaotic if banks had used the blockchain. Using blockchain would have meant that banks had a common system of record for instruments such as swaps, which would have resulted in a more orderly unwinding of contracts. For these reasons, PwC 20 quantifies that blockchain technology has the potential to boost global gross domestic product by 1.6 trillion over the next decade. And for all these reasons, we urge you to negate.
On your first contention, you say that 40% of GDP, or like countries are, there are 40% countries where 40% of their GDP is reliant on remittances. How much of those remittances are in the form of crypto?
I can't give you an exact percentage, but what we do tell you is that cryptocurrency is the main way that underbanked people specifically can access remittances because of the no transaction fees, which apply to other sorts of transactions. So I don't know the exact percentage, but what I will say is that the population this affects are the most vulnerable in terms of reliance on remittances. Could I ask you a question?
Sure.
So in your climate change argument, what are your cards referring to US specific climate impacts, or are they just general global statistics?
Right, so the impact is global, right? But the argument that we are making is that regulation in the US is key because a lot of the mining can happen in the US, and that kind of regulation is important.
Wait, so
not only that, but if you're able to regulate the cryptocurrency transactions and assets that come from different countries, that means that the US would be able to prevent any environmental devastating impacts from those specific assets. Can I take a question?
Yeah, no, quick follow-up. So you mentioned mining in the US. What percent of global mining is in the US?
I probably can't answer that question.
Is it a majority?
I don't think it matters as long as you're putting regulation, you're able to regulate from all areas of the world. Okay. So back on your argument about remittances, right? How much of these remittances to developing countries come from the US?
Again, don't have a percent for you, but the United States is the major world economy. And as a result, there's more opportunities for immigrants to get acquire incomes that they can then send back for remittances. So I'd say it's a pretty large contributor to global remittances. May I ask you a question? So on your tax evasion argument, are you proposing that the IRS is your proposal that they continue what they're doing or change their tax policy?
Our argument is that the further regulation will allow us to have more benefits than harms, right? So the further regulation would allow the IRS to crack down even more.
Okay, and the impact evidence is looking at what the IRS is doing right now.
The impact evidence is what's happening right now as a result of the IRS not being able to do anything. So on your argument about the illicit economy, right? How many more people would go into the underground economy if we were to put regulation?
Again, I can't give you a number for that, but the incentive structure totally changes once you affirm the resolution, because now the regulation and all of that is going to just drive the illicit activity and create a whole new other market. And so essentially what we're saying is this is going to create a worse situation overall. I believe that's time.
Now, let's start on their first argument about migrant remittances. They need to prove a lot of things to win this argument. The first is if remittances are even helpful to these countries. Even though they read these statistics about how it makes up 40% of a country's GDP, what they're not telling you is that these remittances are just money that mostly goes to specific people's families. If these families already have people abroad that are successful, they're probably wealthier than most other people in the country. And B, if most of this money is only going to specific families, there's no reason as to why this money is actually helping the people that need it or going to those people, even if it overall is helping the GDP of this country, meaning that overall their impact can't be realized. But even if we believe that remittances do help these countries, there's no reason as to why cryptocurrency regulation stops this problem. Firstly, there's already been money sent to these other countries through fiat currency far before cryptocurrency was ever invented. In fact, their own evidence suggests that this type of remittances has helped countries long before cryptocurrency was a thing. To that end, even if there's some level of decrease in remittances, their impact won't be realized because money will still be going over to these countries. The second big problem is that they don't even have a link to this argument. Their card just says that regulatory actors should be afraid to hurt these types of populations when they regulate cryptocurrency. But never once does it say why regulation would actually stop money from going to these countries or how regulation would the amount of money sent to these countries. To that end, they literally don't have a link. They just have one person making an assertion or an assumption that some type of regulation might hurt remittances, not that the specific regulations we talk about actually do hurt remittances. As our evidence indicates, cryptocurrency would not go away if you affirm. Rather, it would grow. The only difference is that with regulation, there's more governmental control to restrict bad actors and make sure that there's problems like climate change that are being dealt with. At that point, we would also argue that this argument is a direct double bind with their second argument about offshoring, because if businesses go overseas and cryptocurrency goes overseas, there's no reason as to why remittances won't just be sent from other countries to these developing countries to a greater degree, meaning that overall, their economies aren't going to be damaged. With that being said, let's go over to the second contention about the US economy. Their first warrant is about offshoring. But firstly, you can turn this argument over to our side. The NYU 21 reports that governmental regulations would most likely be implemented by taxing any fiat money you can use to cash out a virtual token. This is bad because Davis O2 quantifies that a 1% increase in, companies would lead to avoiding paying increased taxes, meaning overall that links into our argument about tax evasion, meaning that our impact is only magnified. But secondly, since it already costs a lot of money, they won't do it. But we would contend that since so far as the data centers have already been built, they'll lose more money to abandon those and rebuild them in other countries, meaning businesses are never going to leave the US because they've already invested too much here. But thirdly, even if this offshoring argument is true and businesses go overseas, that doesn't mean the entire US economy is going to be crypto. That just means that blockchain technology that they talk about will be developed elsewhere, meaning that overall, since we trade intelligence with other European countries, none of their impacts about blockchain going down will be realized. On the second argument about scaring investors, their evidence indicates the opposite would be true, because right now people are afraid of buying crypto because they're afraid regulations might come. But if regulations are already placed, then people know what to expect, and people will see that crypto doesn't just go away, meaning that if anything, the fear of regulation only exists in a world where regulation hasn't already been implemented. On this third argument about criminality, it literally doesn't make any sense because there's already an underground market. And if their argument is that law-abiding citizens won't enter that underground market, then the underground market doesn't even grow that much. But if they do argue that law-abiding citizens go into the underground market, that means that none of their impacts are true because everyone will still have access to crypto with no regulation, which is non-unique to debate, especially because they don't even isolate an impact as to why going into the black market is a bad thing. For those reasons, we are very, very proud to affirm.
Is everybody ready? So the order is going to be starting on my second contention and then moving over to the affirmative case. Awesome. Let's begin. Let's start with my second contention about the economy. My opponents are significantly underhandling this argument in the debate, and this is going to be the reason why we win the debate at the end of the day. Their first response states that regulation won't solve because fiat money will be taxed as it's implemented into cryptocurrency, as you buy cryptocurrency. This doesn't make a whole lot of sense because cryptocurrency is an appreciable asset, which means that it gains value over time, which means that if it's only taxed when it's converted back into a US dollar, all that means is that people will just not convert it back into US dollars, meaning that it's more of a tax haven. This literally just disproves the entirety of their argument about tax evasion, as if it's only taxed when it's converted back to a US dollar, then that doesn't really, then people just won't convert it back, and it doesn't really answer our argument in its entirety. The second response says that companies have already invested money into cryptocurrency. Our response to that is that companies are specifically calculate opportunity costs, and new regulation will push them overseas. Just because they've invested money doesn't mean that they're going to stay in the United States. The third argument is that just because things are built elsewhere doesn't mean that's bad. Our argument is specifically that US-backed companies' use of blockchain is key to the global adoption of blockchain. If you don't believe me, look at my opponent's third contention, which states that growth in the US economy is key to global economic growth due to the interconnectedness of the United States economy and the ability for the United States economy to influence developing economies. Their fourth argument is that when you regulate something, it'll get rid of this sort of fear of regulation. That's the opposite is true. When the regulation is bad, that's only going to disprove and it's going to push investors away from cryptocurrency and blockchain more generally. And that's our argument, is that blockchain is good, even if the application of cryptocurrency isn't that good right now. Go to my opponent's case. Their first contention talks about climate change. My first response is that the majority of cryptocurrency mining doesn't happen in the United States already. They don't read one card that indicates that a lot of mining happens in the United States. And this is because it's cheaper to buy energy in other countries, which is why people mine there. My second response is that the status quo is solving for their impact. Euronews 21 explains that Bitcoin upcoming update, Ethereum 2, will drastically reduce the energy need to mine cryptocurrency by using proof of stake versus proof of work, which shows that it will decrease climate change in the future, which means that cryptocurrency isn't actually bad for the environment. My third response, you can delink their argument. Regulation of cryptocurrency is unlikely to include regulating the environmental impacts of cryptocurrency mining and more to prevent fraud and money laundering. Thompson 20 finds that in Congress, there is no sort of universal consensus to regulate things surrounding the environmental impacts. My opponents get to argue for regulation, not a specific type of cherry-picked regulation such as environmental regulation. It's never going to happen. Go to my opponent's second contention about illegal activities. My first response is you can turn the argument against that. The IRS is my first response is that their argument is non-unique. The IRS is already leveraging data and analytics to solve back for cryptocurrency-based tax evasion. Cone 21 finds that the IRS has already increased regulatory oversight, which is solving for their impact. My second response is that there's no impact to their argument. Pimmons 21 finds that only 1% of cryptocurrency transactions are used for illegal activities. This also answers their third contention. And that's important because my opponents give you no comparison. In fact, Pimmons furthers that 5% of fiat money or paper money is used for illicit activities, and only 1% of cryptocurrency transactions are used for illegal activities, which means that cryptocurrency is comparatively better. Why risk the threat to individual privacy for crimes committed by very few people? They also say for every $1 invested, there's a $5 return by the IRS. That's the IRS return on investment for any project. It's not specific to cryptocurrency, and we have evidence from the IRS website that states that's the case. Their third contention talks about how cryptocurrency is important for general decentralization and fighting against cyber attacks. However, they're not able to solve for cyber attacks or even any kinds of crime because you'll just push people to underground and just push people overseas, which proves that our contentions are a prerequisite to this argument, and that decentralization is harmed through regulation because you're not able to regulate it with a central body if the purpose is to be decentralized. So at the end of the day, cryptocurrency is good. It's leading the blockchain revolution. Only regulation can overthrow that and potentially damage the global economy. For that reason, I strongly urge to vote for the negative. All right, Austin.
All right. Yeah, I'm ready for a cross. Yeah. All right. So let's talk about like this argument about the black market. Your argument in case was basically that law-abiding citizens get pushed out when there's regulation, correct?
That was one of the three links that we made.
I understand that your argument is about economic collapse as a whole. I just want to focus on that link just so I can understand it a little bit better. Is your argument on that link just that, like, since law-abiding citizens obviously won't engage with those illicit activities, they're basically just pushed out, right?
So yeah, so the actual link argument is that cryptocurrency regulation threatens the privacy of every citizen. So like if you're regulating it for the basis of taxes, that means that the IRS needs to collect huge amounts of personal data on all kinds of transactions surrounding cryptocurrency. That just basically threatens anybody who's trying to do legitimate activity, and they'll just turn to other avenues besides cryptocurrency and blockchain-based projects.
Okay, but didn't your case argument say that like law-abiding citizens are pushed out completely because they don't engage with illicit activities?
It doesn't say that. It just says any regulatory hurdles will inevitably hamper innovation. The only thing mandatory data collection would ensure is that honest individuals must go through more hurdles and lost even more privacy in the big data. But there is the other link that we
sure go ahead.
Stop.
Okay, you can take a question.
Okay. So I just want to ask about your argument about, or your response rather. So you say that your first response to my contention too was that regulation won't work, or it won't like harm the economy because it's going to have no effect because it's just going to be a tax on the fiat money that you buy a security or like buy cryptocurrency. Is that like your argument?
Kind of, yeah. Like, what's the question?
So I guess my question is, if you just buy cryptocurrency, let's say I buy like one Bitcoin, and then all of a sudden in 10 years from now, it appreciates a bunch in value. Like, and if it's only ever taxed if it's in the form of a fiat currency, like a US dollar, and how does that stop it from being used for tax evasion? If that's the form of regulation you're proposing. Like if it's only taxed if you convert it back to US dollars, why would people convert it back to US dollars?
Our argument is just on the tax evasion point is just that right now people aren't declaring the income they're making with cryptocurrency. Since the resolution doesn't let us define what kind of regulations are actually going to be implemented, our argument regarding tax evasion is that just if there's more scrutiny placed on cryptocurrency, obviously people can't get away with not reporting any of their like gains or losses. That makes sense.
So what types of action is going to be taken? So like what type of regulation? Is it going to be
if there's more regulation on cryptocurrency, there's more you even make this own argument yourself by saying that there's more scrutiny on people's private data. You can see whether or not people are or aren't reporting their losses or gains.
Okay, so it's when the IRS collects huge amounts of data surrounding cryptocurrency. Isn't that a threat to privacy to legitimate business owners?
I would say that like
next time.
Not really in regards to the fact that there's already huge threats posed by A, cyber attacks, and B, like the NSA. So to that degree, there's not going to be a huge invasion of privacy that already isn't experienced.
All right. Would you like to? Are you guys ready for summary? Are you going to take part?
Yeah, we can go. All right. The order is going to be our case, then the neg. Quickly on our contention too, they try to turn it by saying that most money is going to be illegal. We say that even if there's going to be more illegal activity, we say that the other 95% of cryptocurrency is still a threat to the decentralization or the decentralization of the economy. Our argument on our subpoint B of our contention 3 is where you're going to be voting for us in the round. Our Milwaukee 18 evidence tells you that cryptocurrency is currently replacing our existing system by preventing our ability to actually centralize our economy. Our economy right now is already reliant on a central bank, such as the Federal Reserve, to deal with financial crises, who can use monetary policy as well as fiscal policy in order to boost the economy through infrastructure projects and other lowering interest rates and other means, which means that if the economy with cryptocurrencies were to become dominant, it would become much more volatile as cryptocurrencies are much more decentralized, and the massive amounts of currencies that would flood the US would make it impossible for the government to be able to deal with this financial recession. This is key because in the 2008 recession, 64 million people already went into poverty, and if there were no fiscal tools in order to deal with that recession, it would have been 3 times deeper and lasted twice as long, which means that the implications of those policies would have been 64 million additional people into poverty. Their only response is this cross-application about how everyone's going to go underground and overseas. The problem is that this isn't even responsive to our subpoint B, because even if Bitcoin is able to go elsewhere, the ability for the US to have its own currency that they are able to own and control and centralize is what allows it to stop the recession in the first place and actually be able to stimulate the economy. You prefer this argument over their contention to you about the economy because number one, you know it's historically true. You don't know if any of the Bitcoin innovations are ever going to happen, but you know that in the past, fiscal tools from the federal government have actually been used in order to help the economy. Number two is on scope. We're able to affect 64 million people. Well, you don't necessarily know how many people they're affecting. They're only affecting the people that actually own Bitcoin, which is only 7% of Americans. More importantly, let's deal with their first argument about offshoring. First of all, they've basically conceded the idea that European nations that don't have regulation on blockchain technology can literally do the same type of technology and innovation that the US is able to do. So even if there's offshoring, that means that the US is still able to get all of the benefits because the US is able to do information sharing with these countries and are able to get all of the impacts. This has two implications. A, it means that all of the impacts of blockchain are going to be realized regardless. And B, the investor confidence is still going to rally because these people are still going to have the Bitcoin technology that they themselves talk about. More importantly, on their argument about offshoring, we tell you that the US businesses have spent so much in the US, which means that at the end of the day, they're going to want to stay in the US. They say that doesn't mean they want to stay in the US, but this doesn't make any sense because A, the US is a huge market, and B, they've invested so much, so they need to get the dividends and make a profitable return. On their argument of the illegitimate underground economy, this doesn't make any sense because first of all, they've conceded that there's already an underground market, which means that the argument is not unique. And two, law-abiding citizens are not going to go into the black market, which means that their argument is only applicable to a certain amount of people. Moreover, on their argument about investors, their evidence says that once regulations are actually there, literally people won't care because they'll realize that these regulations are actually a good thing. It doesn't matter if people see that as long as we prove that it's a good thing, the argument doesn't matter.
All right, we'll take prep. I'll call you.
All right. So it's going to start on our second contention. Is everyone ready? My time starts now. You're voting for us on our second contention about the economy. In our first argument, we tell you that regulation of cryptocurrency is going to cause the offshoring of American fintech to other countries. My opponent's one response to this is that even if offshoring happens, so they're conceding our link, they say that in Europe, that it's just going to move to Europe and we can still get the benefits. The problem with this argument is our evidence is specific to the fact that American fintech is what is going to create the blockchain technology that will then spill over and help the whole world. This means that if companies move to Europe, we're going to stifle the progress that is being developed within the United States right now, and that is the linchpin to global blockchain development. Our next argument, we tell you that having more regulations is going to scare off investors, and this is going to harm the blockchain development overall. My opponent's one response here is that like people are going to realize that regulations are good, and there's not going to be the scaring off of investors. We tell you when there are more regulations, it's going to impose higher costs, and there's not going to be as much willingness to enter this new industry once these harsh regulations are in place. Therefore, that it's going to stifle their ability to contribute to cryptocurrency and therefore stifle the blockchain. The reason why this is really important is because both our arguments tell you that the American fintech sector is going to allow the creation of a blockchain system that will literally prevent recessions from happening worldwide. Our FUBR evidence tells you specifically that the 2008 recession would not have happened had we had this blockchain technology, because it would be able to because it would be able to give record swaps that would stop the problems that caused the 2008 recession before they even started. Next, our PwC evidence tells you that this would specifically boost the global GDP by $1.76 trillion. Our argument is impacting to the entire world. My opponents are only impacting to the US. But let's look at their argument more specifically. They want you to vote on this idea of decentralization harming the Federal Reserve's ability to put in place a monetary policy. A couple problems. Number one, they're assuming that we are replacing the entire US dollar and read no evidence to suggest that happens. We say cryptocurrency exists and the US dollar still exists. Next, they read no evidence to indicate that regulations are key to preventing cryptocurrency from replacing the Federal Reserve. And so therefore, this trade-off doesn't even necessarily happen. But finally, we prereq their argument because our evidence says that when we have this blockchain technology developed in the United States, it will stop recessions before they start. Therefore, even if you take their contention at their best, we prevent the recessions that would need monetary policies to solve them in the first place. And that is why you're voting for us. We outweigh because we are impacting to the entire world with our impacts. They're only impacting to a US recession at their best. And second, we prevent recessions from starting in the first place because we develop the technology needed in order to stop financial issues before they spill over. And for these reasons, please negate.
Okay, Grand Cross.
Yes.
Shiv, you want to take the first question?
Yeah, sure. What exactly makes American fintech better than European fintech?
We identify like multiple reasons. American fintech is more desirable. First, just a higher propensity to adopt blockchain technology in the first place. European fintech is more risk averse than American fintech. Secondly, we think that
hold on. What does it mean to be risk averse?
Like less likely to invest in new technologies, like new and developing technologies that US-based fintech has. Number two, our evidence indicates that, like in the case of the US, the financial recession in 2008 as well, that was because of US-backed. It was US banks, commercial banks, selling these securities or trading them and exchanging them, and that's what caused the collapse. But when you have blockchain, you have a record of all of this transactions happening, and so having, like, let's say we had blockchain in 2008, we would have been able to effectively prevent the 2008 financial recession, and that's like our argument is that blockchain has huge potentials.
Wait,
why do those two reasons specifically stop Europeans from developing that same, like, blockchain technology?
Because we tell you that the hub of all of that information is in the United States. That's where all the existing infrastructure is. That's where the companies are all located. That's where the technology is being developed.
So when is this technology going to be developed to the point that like all recessions ever can be prevented?
We don't claim to solve every recession ever, but the types of recession that you all are talking about in your case, we can solve back for them, like and severely mitigate.
Like when though?
Like so like
for
when
example,
in the future?
technology.
Yeah. So when is this technology?
For the financial technology sector of the economy, it also has the ability to revolutionize a lot of healthcare-based systems, and our evidence stipulates that. So like a lot of like different causes of recessions, blockchain technology can solve back for. We can't solve back for every recession, but like a lot of them.
I think you're misunderstanding my question. I'm just kind of asking like when is the technology for blockchain going to get to the point that it can do all this? Because obviously we're not stopping these recessions right now, right?
Well, our evidence says, like from PwC says, in the next 10 years alone, blockchain will expand global economic output like $1.8 trillion.
So like, is that $1.8 trillion the bright line to stopping all of these recessions?
No, not necessarily, but that's giving you a sense of the time frame in which the full development will be in place.
Yeah.
So why 10 years? Is it just like the rate of progression right now? Like, is there something going on?
Well, there's no regulation now, so that's why. And we say that you threaten the progress and the trajectory that's been underway.
Rather than that, what evidence do you have that indicates that the decentralization of cryptocurrency right now will overthrow the US?
I mean, it's literally your argument, right? It's that blockchain gets to a point where it's has such a supremacy over currency that it basically capitulates the dollar.
We're advocating for blockchain technology more generally.
Yeah, I'm saying that blockchain technology also subsumes crypto, and when it makes up such a financial core of the US, the dollar isn't used as much, but that's time. All right, it's just gonna be our case, basically, and then like weighing against your case. Is everybody ready? Okay, that case, my time starts now. The round ended when our argument about decentralization was extremely mishandled in the rebuttal. Let's extend the argument. Our argument is very, very simple. Right now, fiat currency is the reason as to why the United States government is able to stop recessions from becoming super bad in the future. That's because we have control over the monetary supply. We can change the interest rates based on the trajectory of the economy, all because we have control over fiat currency. But when there are so many cryptocurrencies that are making up the financial core of the United States banking systems, that means that the government does not have control over them and can't control the interest rates regarding them. This is detrimental because that means that when recessions do appear, the government does not have the power to mitigate those recessions. At that point, let's deal with their responses. They have two, both of which were completely new in the summary. Don't evaluate them. But even if you wanted to evaluate them, they don't matter because both of them are just mitigation on our impact and the probability of our impact happening, when their case ensures that our probability is 100%. If they are true, that blockchain will become to the point where it's so huge and so powerful that it makes up the financial core of the United States, that means fiat currency goes out of the window. We will concede to their argument. This just supercharges the probability of our argument. Let's go to the weighing debate. That's where we're winning the round. There's a couple of ways where we outweigh their case. The first is on a short circuit. Sure, maybe they'll stop one or two recessions. We are solving every recession in perpetuity because we have control over the monetary supply, meaning that even if their recession happens, we'll be able to mitigate it, which they uniquely won't be able to do. B, this argument outweighs on time frame because while they're only able to stop some recessions, we access every single recession, not just ones based off the specific monetary supply argument they're talking about. We solve for black swan recessions. We solve for recessions caused by oil spikes and changes in other commodities, which they don't access. At that point, you should also prefer our weighing mechanisms on probability, because while you've seen our mechanisms work in the past, while you've seen our arguments actually happen in the past, where we've seen the recessions like 2008 get mitigated because we have control over monetary supply, you've never seen cryptocurrency work. You've never seen blockchain get to the point where they say it'll stop every single recession. So you're always preferring us. For those reasons, we're very proud to affirm.
All right, the order is going to be Af then Nick. Let's begin. The round is over when they don't read a single card in support of their third contention at the uniqueness or the link level. They say cryptocurrency and the status quo will overthrow fiat currency. They have not read one card in this debate round that indicates that that is the case. If that's the case, when? We read evidence that indicates that's not the case. Cryptocurrency will not overthrow the entirety of the US dollar. That's just illogical. Instead, it'll be adopted by American fintech as a part of fiat currency, as an extension, not overcoming it. It means they have no uniqueness. They also read no link. Even if they read a card that says cryptocurrency will overcome the US dollar, they read no card indicating that regulation would solve back for this. Also, their impact is illogical. They say that central bank control of the monetary system will solve for every recession. U.S. Central Bank had control in 2008. The Federal Reserve has had control of the monetary system in the United States for more than a century. Their argument is not true. Our argument about blockchain is the reason why you're voting for us in this debate. They've significantly underhandled our link evidence that indicates that cryptocurrency regulation will specifically scare investors. That was the Global Data 21 evidence, and that will stop investment into cryptocurrency-based projects and cryptocurrency underlying technology such as blockchain. That allows us to access our impact. Two cards that are important here. The first evidence is the PwC evidence that independently blockchain-based projects will increase the economy $1.7 billion. This is the only card in the debate. Cryptocurrency won't overthrow the US dollar, but blockchain will expand the economy $1.7 trillion, which means even if you think that their argument is true, you have to weigh that versus the $1.7 trillion increase in the economy that's proven by a card that was read in this debate, that outweighs on magnitude, that outweighs on time frame. It happened in the next 10 years. They can't quantify. But secondly, the next card that was dropped in this debate was the card we read right before that, the Ferber 19 card, that in a case of a recession, central banks won't be able to solve this issue. Blockchain will, because of the distributed technology that would exist across multiple banks. You'd be able to determine when problems happen in the macro economy and stop problems before they started, which means you can prevent a 2008-like recession from happening in the future, which shows that at the end of the day, you have to just vote for the evidence, vote for the magnitude $1.7 trillion and mitigating all future recessions, and vote for the negative. All right. Thanks, everybody.
Good round.
Good round.